I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is a special edition of Bloomberg Technology.
Because, Ed, today we are focusing on the biggest bank failure since the 2008 financial crisis. Silicon Valley Bank started the year with more than $200 billion in assets. Today, California regulators closed the bank and sent it into receivership. Basically, it collapsed. A top lender to VC-backed startups, SVB, the parent company, had quadrupled the size of Silicon Valley Bank in the past 5 years. Now it's the second bank, Silicon Valley Bank, is to fold in a week after Silvergate's bankruptcy. Ed, this story is bleeding into the banking sector, into the tech sector, into the financial markets at large, and has the attention of not only financial regulators, the White House, top venture capitalists, tech founders of all backgrounds. Just tell us a little bit about how it's impacting individual companies at this moment.
Well, first off the bat, trading of SVB Financial Group was suspended, halted, pending news and never did trade, had a really profound impact in equity markets. The KBW Bank Index down 4%, but actually other names, particularly regional lenders where contagion risk and concern was building, we saw pretty deep declines. First Republic and Signature Bank, some of those names. Where we did see severe reaction was, of course, in SVB Group's bonds, its debts. I'm looking at the 2033 note in particular. We are deep into distressed territory, in this case, trading 45 cents on the dollar, Caroline. But what we have is a situation where the FDIC has come in and has taken control of this bank. And the latest Bloomberg reporting is that they are trying to find a buyer to come in and take on these assets.
For what is left, Sonali Basak, who's been on air all day, pushing this story forward as we brace ourselves for this weekend now, Sonali. What do we anticipate to be coming from regulators? What do we anticipate in terms of who could be some sort of salvation right now?
Yeah, I think it's very important to think about the process here moving forward for Silicon Valley Bank, because there's a few things. One, on the regulatory perspective, now that it is in receivership, remember the FDIC retains all these assets now. And if you think about what happens in the event of a sale, they can move through a sale process, or they could sell certain assets. That's one thing to think about. Remember, there's also this issue here for customers, because if you have above and beyond $250,000, you need to be calling the FDIC at this point, because that is the amount the FDIC insures per account.
Right.
Then, separately, you also have this other issue here of what happens to the clients that Silicon Valley Bank has lent to. Those venture-backed loans, are they callable in any fashion? Is there any worries about the clients that do exist for Silicon Valley Bank? Of course, there are many venture capitalists that are very worried about their companies being able to make payroll.
The point here is that this was a technical failure by FDIC standards. You know, Silvergate, also a part of this discussion, voluntarily wound down. But you're exactly right. You and I have been tracking for 24 hours what so many startup founders are doing as well with their own cash, moving it to other banks. We've reported some of that movement. What do we know about what clients are doing to manage this situation, Sonali, with their funds?
Yeah, we know, for example, remember, because some of these assets are not necessarily insured. So those are the assets that we're very worried about the customer base for. But remember, we have been talking about this, Ed. People act like this is something that happened in 24 hours. There's a lot that did happen in 24 hours, but as you know very well, the reason this happened in the first place is because customers slowly started to move deposits. We want to keep an eye on which firms still had deposits with Silicon Valley Bank up till this point, but there was a slow, steady movement, and they had to sell assets at a loss to meet those deposits. Lastly, I would just say, for a matter of definition, this is one of the largest bank failures in U.S. history, in the sense that it is the second largest bank holding company failure since Washington Mutual. Lehman Brothers was not necessarily a bank holding company. There were sales involved at the 2008 crisis era. So this failure is a very technical one, as you're saying, and it is pretty unique in nature, and it is a very different time than 2008, so quite contained, as people see into the market.
And so much of this is about psychology. That's what we keep hearing in the market, psychology of what was contributing to the run. Bloomberg Sonali Basak, we'll have you back later on in the show. I want to bring in Arjun Sethi, co-founder of Tribe Capital, a VC with about $1.7 billion of assets. Sethi says venture capitalists should prioritize founders and their employees, as well as payroll and banking partners. Arjun, welcome to the program. You and I have been talking on and off for 24 hours or so. Where do you stand as a venture capitalist whose portfolio companies use Silicon Valley Bank?
Yeah, I think thanks for having me. I think what's important about understanding the people that are going to be the most affected here are early and mid-stage companies, more so than late-stage companies. By the time you get to a certain stage of revenue and balance sheet, you start thinking about diversifying your risk and the types of partners that you have around the table. So Morgan Stanley, JP Morgan, Citibank, et cetera, the whole list of the larger banks. I think the thing that's really important that people have been forgetting is that our job in our ecosystem, so as an investor, as a fiduciary of capital, as a fiduciary sitting on the boards of these companies, is to make sure that we're giving them the best advice and we make sure that we can help them think about what they need to do. And for a large set of us, not just me, we started giving this advice a couple of weeks ago, probably more so when we got louder over the last week, and then obviously over the last 24 to 48 hours. But it's really just about diversifying your risk, where your cash is sitting, and then how you're sweeping that cash. Is it in treasuries, depending on how much deposits you have in the first place? The second piece I think a lot of people forget is that a lot of these companies do rely on banks. And Silicon Valley Bank was a pillar of the community that helped support a lot of the underwriting the risk of the assets in order to get them venture debt. They worked with a lot of venture funds, but they were a lender. They were also a lender for capital call lines of credit for funds. Funds banked with them, not just our management companies, but the funds themselves.
Yes.
So this actually reverberates pretty quickly in the ecosystem around what it's going to look like for not just the companies, but their backers.
Does your fund bank with them?
We do not bank with SVB. We bank with a larger set of providers that are out there, and then our capital call lines of credit are with different service providers as well.
And Arjun, just dig in. Let's start with the issues for the portfolio companies. If they want to make payroll, for example, you're giving them advice. At what point do you and other VC backers need to give lines of credit, give money without the strings attached to those founders, those companies, if they can't access it from their own banks at the moment?
Yeah, it's a good question. I think there's some venture capitalists that might not be they might not have the capability to fund. It's not as easy as just sending the check. I saw some tweets from some angel investors, in my opinion, that are sort of ill-educated on the process. You can't just wire money to help the company, right? There's a process that you go through. You have to do your fiduciary and understanding the risk of where the company is, and if the company itself is underwritable in the first place. So again, early stage and mid stage, this is more of an issue. Late stage, it's less of an issue. But for some of these companies that don't have the ability to access payroll, I think a lot of what we're trying to do is who can we set them up with that has the capability to underwrite them? What can we do in the short term? Do we do bridge loans? Do we write more investment into the company through equity? I think one of the issues is that you're going to have a lot of predatory folks out there going after some of these companies if they can't meet some of these liabilities. And our goal, again, as fiduciaries, is to make sure that doesn't happen.
What's interesting, of course, Ed, is you've been writing throughout the day. Who then, hate to say the silver linings in these clouds, but who benefits? Where does the money flow ultimately from portfolio companies that are trying to diversify at this moment, and indeed the VCs too?
Well, there are many venture capitalists that believe actually staying put was the right move. But the name that I kept hearing time and time again was JP Morgan, that was getting a lot of phone calls, but also some lesser known banks. Mercury is an example. Some VCs saying, get a bit of your capital in bigger banks, but go with some of the startups too because of the benefits they're offering. What was really interesting as well is this is kind of laying bare the situation right now for being a startup, being a founder, right, Arjun? You've been writing about the desert that we are traveling through in the world of VC and startups. There is a deficit of available capital. And my question to you is, how much worse is that now, given the events of the past 24 hours?
Yeah, so there's two pieces here. Over the last 5 years, I think the way to think about it is the Fed first printed trillions of dollars. Then they denied anything was happening. Then they said it was transitory. Then we put their rates to the moon. So what happens is there's a lot of trickle effects that come from this. So the first is that a lot of venture capital went into a lot of these companies, may they be good or bad. So roughly about $1.5 trillion over the last 4 to 5 years. Those companies, in order for them to meet their demands or growth concerns, they probably need another 3 to 4 trillion of capital. Where is that going to come from? This was before SVB. And so that becomes an issue. Now, all of a sudden you have SVB. People generally get scared. It may not be logical, and there might be capital around the table, but they just get scared and they're deer in the headlights. So I think what you're going to see is flight to safety. What are the assets that you go after? How do you continue to bankroll them? How do you do concentration of your time and capital into these companies? And which ones are going to be resilient? And so, I think this probably takes about 3 to 6 months to go through the system. I do think it gets worse over the next 12 to 16 months, just because a lot more companies will need access to that capital. Yeah. And I think the one thing that people really forget here is that these companies need this capital in order to grow, or in order to hit their certain thresholds of their unit economics, because most of them still haven't been able to shed enough people, still haven't been able to get into a place that's healthy. And the capital needs are going to become greater and greater over the next year.
Ultimately, many are loss-making. Tribe Capital co-founder Arjun Sethi, thank you so much for providing information across social media channels, but for coming on this show too. We appreciate it. Meanwhile, coming up, we'll talk all things SVB, including, of course, regulation. What's next? What's the role of the FDIC here? We'll discuss all of that with Aaron Klein, Brookings Institution Senior Fellow and Financial Regulatory Reform Expert next. Ed, dig into what's also still moving after hours.
Yeah, look, there is some movement. It's aftermarket Friday. You imagine that volumes are incredibly low. It's an opportunity for respite in what has been an extremely volatile session. But you do see some ongoing declines. In one case, Signature Bank were up almost 2.5%. We'll keep tracking those numbers. This is Bloomberg.
There are recent developments that concern a few banks that I'm monitoring very carefully. And when banks experience financial losses, it is and should be a matter of concern.
U.S. Treasury Secretary Janet Yellen there saying she was monitoring the situation, also said that the U.S. banking system remains resilient and that regulators have, quote, effective tools to address the fallout from the collapse of Silicon Valley Bank. She called a meeting, of course, with the leaders of the Federal Reserve, the FDIC, the Officer of the Comptroller of the Currency, to discuss developments around SVB. Before we get to those overall regulatory discussions, I want to bring you some breaking news, because this has huge overarching implications for publicly traded companies. Roku currently saying that 26%, I reiterate, a quarter of Roku's total cash and cash equivalents are held with SVB. The company's deposits are with SVB, are largely uninsured, and they don't know what extent it can recover those cash deposits. So currently Roku, of course, the maker of the way in which you consume perhaps what you're watching in this very moment, 26% of its total cash and cash equivalents are held with SVB. And Ed, existing cash flow is enough for the next 12 months and beyond. Of course, this is a later stage company, a public company, and one that we keep a close eye on, currently falling 6% after hours, Ed.
Yeah, it's a question we're asking, right? Forget not just private startups, the founders. There are a number, okay, they're smaller cap companies, but public companies that use Silicon Valley Bank, because until earlier today, it was a critical bank for the world of technology and companies founded all over this nation and beyond.
And this is why we then worry a lot about the startups who don't have 12 months and beyond of existing cash flow. Let's talk about the ripple effects and where next the regulators are going to be watching, of course. Bloomberg's Kayleigh Lyons has been doing incredible work, having newly moved to Washington and now our regulatory overseer, really. Just talk to us, Kayleigh, about what we look for next coming from the likes of the FDIC and indeed Janet Yellen herself.
Well, for the FDIC, this really goes back to Roku and the question of uninsured deposits, because remember, this is the first failure of an insured institution we have seen this year, one of the largest we have seen in history. But that insurance only goes so far. That cap is $250,000. And from our understanding, more than 90% of the deposits at Silicon Valley Bank were uninsured. So that is really going to be question number one. What happens with those uninsured deposits? Are those depositors going to be made whole? That is going to be one of the priorities that we are following on, especially as you guys were just alluding to, for those early stage companies that may be short on cash at this point. Then it becomes a question of any kind of ripple effects. Are we going to see other episodes of this, or was this an isolated incident? Shadali and I were speaking with a former official from the FDIC who said, look, regulators are really hoping that this is just an isolated incident that they can contain. And I would note that Janet Yellen, as well as the broader White House, including the Council of Economic Advisors Director Cecilia Rouse, did express confidence in what regulators are doing here. And Rouse was quick to point out that this is not 2008. We are post 2008. We are post Dodd-Frank. There are now capital and liquidity requirements, stress tests that are in place. And really, the banking system, in theory, is much more resilient now than it was then.
Bloomberg's Kayleigh Lyons out in D.C. Thank you. The regulatory conversation is not going to stop here, and we will continue it with Aaron Klein, Economics Senior Fellow at the Brookings Institution. You've been working on financial regulatory reform issues for a very long time. The Department of the Treasury, an economic advisor to the Senate Banking, Housing and Urban Affairs Committee. Yellen's saying she has full confidence in the banking regulators. The FDIC has come in, taken control at Silicon Valley Bank, and will oversee the sale process. Do you have that confidence based on your experience in this area?
I do. Look, the FDIC has done a great job in handling and resolving institutions. Actually, generally speaking, they're able to do so at a small cost to taxpayers and tend to recover a lot for uninsured depositors. But each bank failure is a little bit different. Keep in mind, this bank was overseen at the federal level by the Federal Reserve. The Federal Reserve Bank of San Francisco was Silicon Valley Bank's #1 federal regulator. And so the San Francisco Fed should have been on top of what was going on, the bank's explosive growth, and now its very quick failure. But there are a lot of tools the FDIC has to handle this resolution situation. And I do think there's confidence. Look, this is a large bank. 16th largest bank in the country.
Yeah.
But it's not your typical bank. It only has 16 branches. It's a very different structured bank than most of its peers around that same size.
Aaron, just to bring you the breaking news that continues to unfold, we currently understand that SVB Financial Group, perhaps unsurprisingly, is going to be removed from the S&P 500 as an index. Insulet is the company that will replace it. But just talk us through what got us here ultimately, and whether the regulations that you have been so crucial in forming in many ways and analysing the repercussions thereof, whether they're the right regulations, the right ways in which banks currently hold capital, but in some ways can lead to extraordinary circumstances that we find with SVB.
Right. So let's start with the premise. My premise is banks should fail. We have nearly 5,000 banks in America, and a healthy amount of failure is greater than zero. I was more concerned the last 2 years when not a single bank failed. Which, by the way, the first time in American history we went a year without a bank failure was 2005. Regulators told us the banking system was in great shape and not a single bank failed again in 2006. Oops. So a little bit of failure is actually a desirable thing, not something to be afraid of. The question is, when an institution fails, is that failure contained? Who bears the losses of it, and how quickly can this situation be resolved? And in that situation, I think the regulatory tools the FDIC and the Federal Reserve and other regulators have now are light years ahead of what they had in 2007 and 2008, when the cause of the crisis was very different.
Aaron, a lot of people out there have a lot of questions, principally startup founders who were banking with Silicon Valley Bank. When the FDIC comes into an institution in this situation, what is their priority? You look at the chart on the screen, you can't even see it on the right-hand side, because this is the first technical FDIC failure in a very, very long time, in the first of this year.
So, Silvergate Bank is another bank that failed very recently. If you want to call it a technical failure or not, sometimes the FDIC is able to negotiate purchase and assumptions here, where other banks take the assets of the other bank. The FDIC's #1 priority are the retail customers and the insured depositors who are going to be able to have access to their money almost like nothing happened. There's just a bit of a rebranding. That's their #1 priority. Uninsured depositors, businesses, their #2 priority is to try to maximize the ongoing value of the institution to minimize the loss felt by everybody, including uninsured depositors. But I want to point something out here, and I hope we get a chance to discuss it, which is the FDIC isn't the first person to have a claimant.
Yes.
So if you think about who owes who has a claim on this bank's assets, the FDIC is number 2. Number 1 is this kind of arcane part of the government called the Federal Home Loan Bank system. And the Federal Home Loan Bank of San Francisco had lent more money to Silicon Valley Bank than to any other bank they did business with at its time of its failure.
Okay, so dig in, therefore. You've done analysis on what other companies, what other lenders have perhaps exposure to the home loans element of things. Are we likely to see, what's the contagion risk here? What's ultimately going to be the likelihood of also the uninsured companies, the likes of Roku that comes out and says 26% of its cash balances are over in Silicon Valley Bank and ultimately aren't insured? What are the ripple effects here?
So there are a couple things. Number one, the people that run to the home loan bank system that are heavy users of it, particularly that come very, very quick. A year ago, Silicon Valley Bank didn't even appear on the top list of borrowers from the Federal Home Loan Bank of San Francisco. And, within a year, they vaulted to number 1, $20 billion of outstanding advances. Silvergate, at the time of its failure, had over $4 billion of outstanding advances. So you look at the list of other people that have started leaning very heavily on the home loan bank system, and you ask the question, why? Why are they going there? Particularly a bank like Silverbank, which isn't really making mortgages, right? The purpose of the home loan bank system originally, when you go back 100 years, it was supposed to be a Federal Reserve kind of for these things called thrifts that used to make mortgages when America had a very different banking system, and a bank and a thrift were different things. So I kind of look there. That's a classic red flag. If you go back to 2007, Countrywide, Washington Mutual, all of those folks were the ones that were running to the home loan bank system in 2007, long after the market had started to dry up on the asset that they were overinvested in.
Yeah. Brookings Institution, Aaron Klein, we thank you so much for the intricacies around regulation there. And we want to go back to the companies that are currently exposed to Silicon Valley Bank that are going to be worrying about, well, whether their deposits, whether their money at the lender is going to be insured. Roblox coming out saying the SVB situation won't affect its operations, but Roblox, of course, the gaming company, says 5% of its balance is held at SVB. Roku has already come out and said 26% overall of its cash has been held over at SVB. Existing cash flow, though, is enough for the next 12 months and beyond, they say, and they don't know what extent it can recover those SVB cash deposits. One last headline for you. Rocket Lab has deposit accounts with SVB totaling a balance of $38 million. It's about 7.9% of cash and equivalents with SVB. We have so much more going on after the break. This is Bloomberg.
I'm Priya Anand on the Startups and Venture Capital team. I'm outside Silicon Valley Bank's office in San Francisco. They're in the NASDAQ building. All morning, there's been a slow trickle of customers coming in, only one every 15, 20 minutes or so, and they're being redirected to the bank's Palo Alto office on Sand Hill Road. They're being told that if they want any information, that's where they have to go. It's unclear whether anyone is even in this office right now in San Francisco.
Welcome back to a special edition of Bloomberg Technology. I'm Ed Ludlow in San Francisco.
I'm Caroline Hyde in New York. On the ground reporting there. Let's get back to what happened in the day's markets trade, in the week the markets trade, because remember, this did seem to evolve all at once over the last 24 hours, but it has had a damaging effect on the NASDAQ, on risk sentiment in general. The overall collapse of Silicon Valley Bank, which swiftly followed, of course, Silvergate earlier in the week. The NASDAQ's off by 4.7%. This is also largely to do with the Federal Reserve, with the increase in interest rates that many brace for. That's ultimately behind the collapse of these lenders. We're seeing crypto on the downside, more than 9% having its worst week since mid-November. We're looking at the flight to safety, yields crescendoing lower. The US 10-year yield off by 1/4 percentage point. Move it on. Look at what's happened across the assets, Ed. We're looking at the bond market that really exemplified some of the risks inside what happened with Silicon Valley Bank, how swiftly the overall bond prices fell. Silicon Valley Bank, SVB, the parent company, 43% is where they're trading at. So just 43 cents on the dollar for your bonds. We're seeing also, though, some marked discounts for other key lenders like in the space. In purple, of course, you can see the likes of some other of those smaller lenders. Western Alliance is there. First Republic is there in the teal color. Ed.
The next question is what happens to the future of those assets held by the bank? What happens to the bank? And what happens to the companies that we're banking with, and not just the private ones? We're getting loads of headlines about the public companies, their exposure to SVB and what they've done to mitigate it. Joining us now, Bloomberg's Max Reyes. Max, give us the latest headlines and news out of Silicon Valley Bank.
Sure. Well, exactly like you're saying, Ed, we are seeing public companies come out in regulatory filings this afternoon telling us essentially how much exposure they have, how much money is locked up at the bank. And just to kind of make sure we're all on the same page, when you see a bank run like this, the concern is that if you have deposits that are not insured, if the bank fails, you won't have access to those funds, and it becomes a question of whether or not you're ever reimbursed, right? And particularly with a commercial bank that is so focused on one sector, if everyone panics at once and you see this drawdown that's kind of motivated by talk on Twitter, by talk from VCs telling their portfolio companies to get out, you see this sort of situation, right? It's almost, a classic prisoner's dilemma where if everyone works together, we won't see this happen. But if even one person breaks, you have this situation where folks are really in dire straits with money locked up in this bank and no clear way of getting at it.
Ultimately, Max, talk to us about the contagion effect. We're just seeing the bond prices of some other lenders there. How much are people now focusing in on other regional lenders, other key constituents that maybe some are focused on the tech sector too?
Yeah, I want to be very careful with how I talk about this, just because SIVB is a very unique animal when it comes to banking. There's not really a bank with such a singular focus. Silvergate was the same way, but for crypto, where it had this very, very myopic focus on this one industry, which made it very susceptible to a moment like this. But yeah, there is definitely concerns around contagion. People are afraid that this could happen elsewhere. And the key thing driving it, like you guys have been saying all day, is interest rates. The fact that the banks, their asset side of the balance sheet has been underwater for a while at this point, just because they bought these bonds for less than they're worth currently, which means that if they do have to sell them, they're going to realize losses. And that's what we've been seeing here. And that's been driving this, I think it's fair to call it a crisis at this point, at least among a few banking institutions in California. And I think everyone is trying to sort out what comes next, but I don't want to prognosticate.
Max, I have a feeling you have a busy weekend. We thank you so much, Max Reyes. He's been just so thorough on this story. And there have been ripple effects far and wide. Let's dig into, of course, the impact on startups, on the venture community in particular. Jenny Fielding, well, she's well known in seed investing. She's managing partner and co-founder at The Fund. It's a VC firm focusing in early stage tech startups. You have not only an adjunct professor at Columbia and teaching at Cornell Tech, but you're also very prolific when it was work with Techstars. Jenny, what have you been advising your portfolio companies in this day alone?
I mean, it's been incredible chaos. So my phone has been blowing up. We have 250 portfolio companies, and I'd say about 30% are involved with SVB. So the first thing we said to them yesterday is we need to stay calm and we need to all get collectively on the same page of what's happening. So in our case, we have 250 portfolio companies. We have another 500 LPs that are also founders. So all of these people we have in our community, and they're really suffering. So in terms of advice, we tend to take an approach of let's share information, and founders need to make their own decisions.
Ultimately, do you have a relationship with Silicon Valley Bank as well at The Fund? And what have you decided to do in terms of your own working capital and money that you have with them?
We do. I've had a long-standing relationship with SVB. They've been incredible supporters of the startup ecosystem, and quite frankly, of the emerging managers like us as well. So they've been absolutely critical. We do have a banking relationship with them, and we do keep assets with them. And so it's been a very hard moment. We're trying to help our startups. We're also trying to help ourselves. So just that contrast has been, quite hard.
Jenny, what I keep hearing from conversations with venture capitalists and founders is honestly there's a real concern here, not just about the operational and cash needs of startups, but their mental health as well. And I just wondered if you'd reflect on some of the conversations you've had with portfolio founders today and how difficult it's been for them as leaders, as business operators.
I canceled pretty much all of my meetings today just to field calls from founders. This is a very unsettling time. I mean, this is a very hard time in tech, just in general, right? The markets have created a lot of pressure on these companies. Raising capital is not how it was, last year. And so compounding what's happening today, a lot of our companies are really suffering. So we try to be a sounding board. We try to listen. We try to provide resources. But ultimately, it's just a traumatic time.
There was a proposed idea from Sam Altman that actually what founders and startups need right now is cash. Just give cash if you can. Does that make sense to you? Is it a sort of stopgap for what's happening out there in terms of making payroll and working capital?
It really does. I mean, venture capitalists like to run around saying they provide value. Well, this is the time to provide value to your portfolio companies. You need to listen to them, and you need to be able to support them. And many VCs are able to do that or provide resources, right? There are other opportunities for people to kind of come in. But yeah, if you have payroll and you've been, tied up in Silicon Valley Bank, and that money, maybe 250,000 is available on Monday. If you have 50 employees, right, making 150,000, you're in a deficit of about $100,000 just this Monday. So everyone is quite nervous, and I think it is a time to chip in and support our founders.
To that point, Parker Conrad of Rippling, which is in many ways a company that helps with payroll, and they themselves discovered yesterday, of course, the Silicon Valley issue and the fact that they have their own exposure, and they notified some customers that, look, some payroll processing is going to be stalled because of SVB, even though they did actually switch their banking to JP Morgan in large part. Talk to us about, does this have a cascade effect? Like, what do people do about not being able to make payroll? Do they have to let people go?
I mean, it's a really interesting question. I think that the most important thing is there's open communication, right? We saw in the waves of layoffs, when there isn't good communication with your employees, that's when things really go awry. So have communication. Our founders are speaking to their employees all the time, today, of what's going on and really warning them. And I think that's a great sign of leadership, just being proactive. But yes, there is a real worry that payroll will not be made on Monday.
Jenny, Arjun from Tribe Capital was on the show earlier. He makes the point that there was already a funding deficit prior to the events of the last 24 hours. He expects a number of startups to fail, but not as many as you might think. What is your outlook for the health, particularly at the early stage?
So interestingly, the early stage has been somewhat shielded from some of the stuff that's going on. So if you were a startup in the Series B, Series C, it's been quite dire. But early stage has been okay. So our trajectory, we're long-term investors. We invest at the first round of capital. We want to hold our positions for 10 years. So we have a better outlook long-term. I think short-term we need to support our founders, and we are worried about the short-term.
Jenny Fielding, managing partner and co-founder at the fund, helping us cover this story in the short term, but we will continue the conversation in the long term. Now, coming up, what the SVB failure means for the crypto space in particular, and for the argument around decentralized banking systems. That's all next.
Yeah, it's been a torrid time for crypto after the last 5 days, but what a torrid time it has been for SVB. Shares, of course, halted today, but ultimately seeing absolute collapse in valuation yesterday, stopped plunging even before the official collapse, where we know the FDIC has now stepped in and taken over, and Silicon Valley Bank, which is owned by SVB, is in receivership. We'll keep you abreast of all of the public companies currently disclosing their own exposure to SVB, one of them being Roku, saying that it has a substantial amount of cash with the company and doesn't know how much of that uninsured cash it will have access to longer term. And Rocket's Lab as well, with more than millions there. Roblox Corporation saying that its operations won't be affected, but it too has cash and a relationship with SVB. This is Bloomberg.
I think the right thing, the prudent thing we've learned is counterparty risk once these things start. This is a classic bank run. And when the bank run starts, you don't want to be the last guy there and wondering what happened.
Avalabs. John Woo, reaction to the SVB news in real time on last night's show. And look, let's just discuss the implications on the crypto space, but also, well, startup space writ large. Dave Weisberger is with us. He's CEO and co-founder of CoinRoots. It's a crypto spot and derivatives trading platform. But also, Dave, you're an expert in TradFi, as many will call it, traditional finance market structure. You built electronics trading systems and platforms across names like Morgan Stanley, Solomon Brothers and the like. Just tell us at the moment whether this is a systemic issue across banking, and also what it means for crypto companies such as yourself.
Well, it's fascinating, actually, because if you think about the core of crypto and what Bitcoin is about, it's really about the opposite of fractional reserve banking. It really is about distributed, not having to take counterparty risk. I won't take credit for it. Mark Yusko from Morgan Creek basically does a great job. His point is crypto is truth technology to replace the need for centralized trust. And so long-term, events like this are massively bullish for the crypto complex. Now, many of the assets in crypto will actually be hurt by this. Bitcoin, I think, will be helped, and we'll see how it goes. As far as is this systemic or not, that's a different question.
Well, you were tweeting earlier, Dave. I'm going to bring one of your tweets up on the screen, but your basic argument is that the contagion risk, the risk from the banking system is actually much more potentially damaging to crypto and tech than it is to banks from crypto. Explain your logic here. What do you mean in this tweet? What are you trying to say?
Well, I mean, at the end of the day, every time there's been an incident in crypto, it hasn't spilled back over to the mainstream until FTX. Now, FTX is separate from all the other failures, right? So we had three huge failures in 2022 in the world of crypto. All were preventable with principles-based regulation that we should have had, and should actually build, but don't have, right? The first was lots of money in a stable coin that wasn't stable. I had $0 in Luna, $0 in UST, thought that basically the whole notion of an algorithmic stablecoin to me sounds like a Ponzi scheme. It's recursive, to use a quantitative term. And ever since Basis came out with their first white paper, despite the pedigree, academic pedigree of the authors, I thought it was a terrible idea. I still think it's a terrible idea, and I probably will, whatever. So that was that one. And regulations that say stablecoins have to be fully backed makes that not be a problem. The second, which was far worse, was from bad disclosures. And there's probably the only point that I know of that Gary Gensler and I agree on completely, which is firms should have to disclose their risks, right? The third one, which was FTX, was far more like Madoff than like anything else. They simply gambled away somewhere between $8 and $10 billion and stole it from their customers. That had nothing to do with crypto. They could just as easily have been doing sports betting. Doesn't matter. They lost a lot of money and stole it. That's not a systemic risk from crypto. That's a massive theft. So if you actually look at everything else, all the other major volatile events in the history of Bitcoin and crypto has never really spilled over to the traditional financial system because there really isn't a lot of impact there. But
so Dave, 24 hours ago, okay, Caroline and I were having this discussion that actually this is all the net result of higher rates. And what higher rates have done, Caroline, right, is cut froth out of the market. Where is the most froth? Well, according to Bloomberg reporting, it was in the crypto sector.
Yeah, and ultimately that was what the demise behind Silvergate, because people had to pull their deposits. Then, of course, the tech community needing to pull their deposits to basically get through the cash burn. And Dave, now, you were just mentioning stable coins. And I'm interested as to what happens if some of the key stable coin proponents, some of the companies behind it, have relationships with Silicon Valley Bank.
That is a great question, and I wish I knew the answer. I don't know Jeremy Allaire from Circle. I'll be perfectly blunt about it. We've never met. But if I were running Circle, I would have had 98% of my deposits in T-bills and T-notes. There's no reason to have bank investments. You need banking for liquidity on the margin. So it should be a very small amount. Now, why do I say that? It's because I'll tell you, at CoinRoutes, for example, we were offered bank savings accounts. and we compared that to 3-month and even 30-day T-bills for our cash needs. And the reality is you get multiple percent higher by investing in government debt, which is obviously far safer than you do in banks. So the real issue is if you look at bankrate.com, they'll tell you the average savings account rate is 0.25 or 0.23%. So one has to ask oneself the question, why are people leaving money in bank deposits? That's a really, really interesting question. And I don't know the answer to that. I can tell you at CoinRoutes, our treasury for our 3 years plus of runway is sitting either in very large banks or in treasuries.
Just on the issue of Circle, we will go to them and get comment and their side of this story. I don't see yet any commentary from them on the Bloomberg terminal today. Either way, CoinRoutes CEO and co-founder Dave Weisberger, thank you very much. Now, up next, the implications on Silicon Valley itself, the place, but also the tech sector as a whole. Let's talk about all of that, not just that view on your screen, but also the miles and miles of companies, founders, venture capitalists behind it in the distance. We'll bring all of you that next. This is Bloomberg. Let's talk about how the Silicon Valley Bank meltdown has impacted Silicon Valley, believe it or not. You know, we've not really talked about out west and all of the companies here that are suffering as a consequence of what's happened. I'm going to bring in Bloomberg Sonali Basak, who's been across the finance banking side of this all day long, and also Bloomberg executive editor Tom Giles, who's been leading our coverage from the tech perspective. Tom, I'll start with you. I mean, what we're learning increasingly and rapidly is it's not just private companies, startups and founders with exposure here. There are publicly traded technology companies with exposure too.
This company, this bank had its tentacles across so many different industries, across so many different types of businesses. It wasn't just startups, as you said. These are publicly traded companies that kept a lot of their cash with SVB. And clearly, when you have 26% of your cash, that's the case with Roku, that goes well above what's insured. And so this is a company that's falling in late trading. They disclosed in a regulatory filing, their shares are down 6%. 26% of their total cash was held with Silicon Valley Bank. Rocket Labs is another one. Now, we're also seeing a lot of companies coming out and saying, we have no exposure or we have very minimal exposure. I think that's something that these companies need to share with their shareholders who are concerned about exposure to a bank that's just gone into receivership.
500 million thereabouts SVB has with Roku of its almost $2 billion in cash and cash equivalents. Sonali, what next? Push us forward for what we hear from not only we wait for the publicly traded companies and private ones to disclose their exposure, but the FDIC in this process and indeed the regulators. We've got a weekend to work this out.
We have a weekend, in essence. Remember, there's a question here of whether they'll look to seek a buyer in full or a buyer for some of the assets. Remember, Silicon Valley Bank, there's been a lot of complications. For any potential buyer that's coming in, they would have wanted to buy the relationships. They would have wanted to buy in all of the, think about how big some of these businesses have gone. Investment banking, they had a large wealth client base as well. These are attractive to a lot of Wall Street. But with all of that said, you know, what are the troubles that still exist for the client base? I think that is the first and most immediate concern, no matter what. And especially if they do find buyers, what happens to those asset bases in that event, especially if not all of it is sold, do some parts get left behind?
Tom, on the technology side of this story, where does this rank in all of the crises and mega tech stories that we've covered in this newsroom over the years?
I mean, this really is up there. This is stuff that speaks to a very visceral, fundamental fear that you have as a person, as a company, as a business. And that is essentially where I'm putting my assets. You think that they're safe. This hits at the fundamental fear for any business, which is my savings are not safe. They're not what we expected. These, you know, putting your money in a bank is not supposed to be this speculative game. This isn't investing in crypto. This isn't investing in securities. It's not even investing in bonds. This is just keeping it in liquid cash, money market securities. So this really cuts at the heart of the trust relationship that exists between a business and its bank.
And ultimately, Tom and Shonali, this is why the White House weighs in, why the Treasury Secretary weighs in, why we all await what indeed the rest of the regulators are going to say over the course of the weekend. Shonali Basak, you're going to be busy. I think Tom Giles, too. We thank you both so much for your time. And that does it for this edition of Bloomberg Technology. But Ed, we've got some big moves to make on Monday.
We're back, but we are relaunching. We're new, noon Eastern, 9 a.m. Pacific, with the new Showtime, Caro, where we are going big. And this, as we go to break with one of the biggest stories, at least in my career and your career, this is Bloomberg.